My biggest regret today is not starting the month the way we did in January. This was the biggest winner today, EVP1. When it took the trade, I was watching. I thought that's probably going to be a good trade. EVP1 lost all, was pretty much straight down in January, and we traded the first 2 days before we waited for our strategies to go into a drawdown. And my biggest regret is not starting February the same way. This was up 5,000, and it gained back all the losses and then some by 2,000, up to 2160 on the year after going straight down in January. This is where the equity curve was in January. It went straight down, gained it all back plus 2,000 on this one trade. And so I am glad we're not trading on FOMC day, though. It was up on the day because our portfolio calculator tells us that is better to do that. We do that. So let's look at this. 250K portfolio, the signals, if we would have traded on FOMC, are plus 48.15 on the 250 and up 963 on the 50K. Let's look at the portfolio calculator though. And this number is 69.70 if we don't trade on FOMC, or it's actually 69.70 if you trade on don't trade on FOMC, but if you add a 1 here, it's 7,019. This is through yesterday. So this goes up. This goes down by 300. That's not a big deal, but it does. It reduces potential slippage and volatility and technical errors. You have to consider technical errors when you trade on FOMC as well. And so still don't want to trade on FOMC, and I still want to wait on a drawdown. So the strategies in general, if you do trade on FOMC, have done 5 out of the last 6 days in run-ups. And today, let's look at the path of the drawdown curve and the trading system signals. So this is the money management algorithm indicator. It combines the equity curve of all the trading systems in our stock index portfolio 18. And 4 of those strategies have been adjusted for 1-minute charts. And so there's only about a 1K difference. There was one strategy that had 1K loss that on the 1-minute chart that did not exist on the 5-minute chart. So keep that in mind when looking at this. So the drawdown here was around 6,000. It was close to break even there at this point. And so you saw the strategies, divergent price action. It ran the lows, ran the highs on the FOMC, ran the lows again like it ran the highs. Thought it would do this. A trend was spawned. And it's hard to interpret the FOMC press conference and statements. I certainly did not anticipate this. And then at the end of the day, Meta earnings, the market pulled back here, so that put it back right around break even at this low point, close to break even. And then Meta earnings came out, and there were 2 strategies that were long, and when it popped, those 2 strategies were responsible for the net profit. You see that? It went from minus 5,000 to plus, I guess, almost 5,000 down to break even and then back to plus 5,000. So that is the nature of the equity curve. We saw yesterday how it sold off and then it rallied back. It's kind of in euphoric mode. It's just trying to push the market up at the close. It continue to see that here. Pullback rally, pullback rally. And so this looked a bit euphoric to me today. Let's look at the trading system signals on the day, and I want to discuss some additional money management algorithm techniques also. So these are the trading system signals on the day for the S&P. You see Cobra CT3 was just stopped out on that low. The statement came out here, and you can see how wild the market gets. Doesn't usually spawn this big of a trend. Cobra 3 was profitable on the day, hitting a $1,000 profit target. Tick Fader was profitable earlier in the day before FOMC, and Mirror lost at the open, stopped out minus 525 on the low, and so there were 2 for 4 on the day. Not a huge P&L on the let's see, 1700. It's down a little bit, but about minus 400 on the S&P for the E-minis on this portfolio setup, because Cobra CT3 had the biggest loser. Even though it was a big winner yesterday, today it was just stopped out that lows. I thought that was interesting. So let's look at the NASDAQ strategies. These are the NASDAQ strategies. See, Viper had 1 trade. It was up on the day, and tick pullback, had a nice trade at the close. You can see how it went up, back to break even, and then back up. It was the one that held at the end of the day for those meta earnings. And then we had tick reversal. These were losers on the day. It got, the Cobra CT3 was long. It was stopped out here. Then tick reversal was stopped out here. This tick reversal was stopped out here. And then this one got in again at this point, which looked like a bad trade at the time, but there was a lot of follow through. And then the trade of the day was EVP1. Just a massive gain here, plus over $5,000 on this one trade. This is the one trade that made the difference. That we were only trading this strategy at the beginning of January. Should have stayed with this because the risk is low, and it did have such a bad January. And so I still want to maintain this and wait for a drawdown and not trade on FOMC, because every now and then you get a strong trade on FOMC. Most of the time we've seen chop that could change in the future, but we're going with our data. And this is a rare trend on FOMC day, rare surge at the end of the day on meta earnings. And so we missed that because we don't want to trade on FOMC, but I want to show you some money management algorithms as well. So here is the indicator that exports the 1 minute P&Ls, and you can see the path of the profits and losses today, path yesterday. This is just normal trading. It's hard to micromanage it, so it's just straight up all the time. You see Fridays, it went down at the close. On Monday, it was just kind of down all day, and then Tuesday back and forth. And then today, you can see the path was really volatile, and we really want to cut down the volatility in the equity curve and avoid those kinds of days. One of the things I have found, though, is that after a big up day, which is surprising because this doesn't look like a big up day, but it was a good day trading yesterday, and after a day of that gains more than 5K, if you wait for about a 4K drawdown to start the next day, normally you would start at the beginning of the day, but if the previous day's gains were over 5,000, you can wait for it to go into a $4,000 drawdown the next day to start. And then the following day, regardless of what happened, if it made 5K, again, then you wait for it to go into a 4K drawdown the next day. And then once you have a day where the P&L is less than plus 5K, then you just start at the open. And so that's interesting. I'm going to show you that setup. And so that indicator that you see at the bottom of the previous screen has been plotted as static data. So this is the equity curve. This is yesterday's equity curve, and it can be correlated to the market, but you have to consider that on short trades, if the market goes down, the equity and we have short positions, the equity curve will go up. And so today would have been one of those days where the P&L is greater than 5K, and had we waited for a 4K drawdown, it would have worked out perfectly, pretty much starting after the trades were stopped out on the initial FOMC response, and then starting with that EVP1. And so setting it up for automation will be challenging, but I'm going to show you the performance on that, and you can see what I'm talking about. Let's look at the performance report for this, and this is trading the you almost increase this to 5,000. Previously, it's around 4,000. If you just trade it, the largest losing day is 12,000, and I'm going to show you what this looks like. This number is not that much bigger. This number is not that much smaller, but it's an incremental way to improve your trading and reduce the volatility in the equity curve. And so I'm going to show you the base strategy next, what it looks like. So the gains are very incremental. This number doesn't change much. This number changes by about 4,000. This number, largest losing trades, changes by about 2,000. This number goes from 4,071 to 4,800, from 4,071 to 4,800-ish. And so, reducing the max drawdown by 4,000 is a good thing. Implementing it it'll be necessary to implement it in each strategy for automation. And you can see here, this is just the base setup though. When we implement it, we want to anything we want to implement differently than this will be a bit of an effort, and so it's still a work in progress. So let's look at trailing stop losses as well. So here's the code for this. If the data is not equal to the data 1, then we buy the next bar at the market, and then we exit at the close. Let's see, if the time is equal to 15:48, then set dollar trailing of $1,000. So if it's 12 minutes before the close, we set a $1,000 trailing stop loss. Let's see what happens. It improves it just a little bit. This goes from 26 to 25. This goes up by 40K. And so it does improve it some. And let's look at, you're talking about the last 12 minutes, you're inserting a $1,000 trailing stop loss. And so let's look at time is equal to, let's just use a basic trailing stop loss so you can see what I'm talking about. Set dollar trailing 10,000. I want to show you the results for this. You can see what I'm referring to. So it goes down quite a bit. Another thing that we can test is if max position profit is greater than 5,000, then we set dollar trailing at 10,000. So let's wait and see what that says. You can see it doesn't improve it very much, not better than the original strategy. If max position profit is less than 5,000, so say you are up, 2 or 3,000, then you can set the dollar trailing to 10,000. Let's see what that would do. If you're up 2 or 3 or 4, or anywhere up to 5,000 on the day, you want to tighten up your stop loss a little bit, and that doesn't help it. That reduces the largest losing trade from 14,000 to 12,000, but doesn't change this that much. And so it might be worth it to reduce the largest losing trade, but it doesn't change the max drawdown very much. And so this is a very incremental idea as far as the trailing stop loss. What we originally looked at, if time is greater than 10 and set dollar trailing, we could try $2,000. The value being used was actually 500, and we're still exiting at 1614 because that's hard coded. So let's just optimize this real quick, and then we'll take a look here. 500 to 5,000 and $250 increments. I'm going to optimize this, and we'll take a look. So using a $1,000 trailing stop loss in the last 12 minutes boosts the performance by reducing the worst case drawdown by less than 1,000, but increasing the total net profit, reducing the largest trade by $250. It's a lot to implement for a small gain. And so I wanted to share with you some of the latest research on the money management algorithms as we continue to research better and better approaches. And I do like the wait for a drawdown after a big gain on the day. And so the next day, you wait for a $4,000 drawdown if you're up $5,000 on the day. So for example, this data does not include today's trade. This is of yesterday. We would wait, for example, today if we were trading this and it's up 5,000. It's not up 5,000 though. So if it's up 5,000, then you would wait for tomorrow to go into a $4,000 drawdown before you started trading it, and you'd use a tighter stop loss. Here is the code for that. If the total profit is less than 5,000, then you just trade it normally. Buy next bar at market. If the total profit is greater than 5,000 and the time is between those two times, and the close is less than negative 3,500. I said 4,000. What I did originally was say buy next bar at minus 4,000 on a limit, but you can't really do that. You can't really implement that with the money management algorithms. It'd have to be a close below minus 3,500, then buy next bar at market. So it'd be hard to place a limit order like that for actual programming it. So we're using minus 3,500. So that's the strategy. Wait for a drawdown, and then after a big winning day. And so that is the latest report. Let's look at the, we already looked at the trades on the day. So once again, we set out this FOMC day. We'll continue to sit out FOMC days until our data tells us to do something differently. And we'll wait for a drawdown, as much as a $10,000 drawdown, to get in on this. And that I may do that intraday as well. So stay tuned for the alerts if you're a subscriber. And those are the trades on the day for FOMC, February the 1st, 2020. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.